Wherever you're in the world. Welcome to another financial modeling brought to you by your BizEdge. So for today's session, we're having valuation approach, technical hands-on. It's being brought to you, it's being presented by Daniel Mensah. This session is brought to you by the collaboration between your BizEdge and Financial Modeling Institute. So for some of you that may be interested in writing the financial modeling exam, such as AFM, CFM, MFM, you can always go to the website and get more information about it. So I'll give a brief description about us, which is your BizEdge. So your BizEdge is a registered Microsoft Excel consulting, financial modeling, business intelligence, data analysis, and enterprise solution firm in Nigeria. Also, we specialize in helping companies and high-value professionals be on top of their business data. We're also the developer of some financial tools you can find here in Nigeria, such as Nigerian Finance Market Analysis Tool, Nigerian Stock Analysis Dashboard, and so many other financial analysis tools. As you all know, also, we're also a training company, so I'll be giving our calendar for upcoming training. So the 21st of July, we'll be having business intelligence and dashboard using Microsoft Power BI. Also on the 29th of July, we'll be having in-depth Excel training, executive dashboard, and business data analysis. On the 1st of August, we'll be having financial modeling and DCF valuation. So I'll just give a brief description about our special guest, Daniel Mensah. So Daniel Mensah is a financial analyst with over 2 years experience with working with startup and small business in their bookkeeping, financial reporting, budgeting, financial planning, and financial modeling. He served as teaching and research assistant in Ashesi University in Ghana, where he has taught financial related courses and helped gather financial data for preparing financial case studies. He holds a bachelor's degree in business administration from Ashesi University and also financial modeling and evaluation analyst certificate for Corporate Finance Institute. So no further ado, I'll hand over the session to Daniel. So Daniel, over to you. I'll stop sharing my screen right about now.
Okay, thank you very much, Temi Dahiru, for the introduction and also for the opportunity. Special thanks to Michael Olafusi for um, allowing me to be on this platform because, I mean, when I went back after the session the other time, and I looked at the program outline for the following weeks, I realized that if we were to look at the profile of the people that were coming here to present, then um, maybe I shouldn't be here because I mean these are top people with lots of experience and education. But thanks for allowing me to be here, even though I'm getting started or I'm young in the field of finance. So thank you for the opportunity. I really appreciate it. So the other time, so please let me know if you can see my screen. Can you see my Excel, please?
It's coming up.
Sorry,
It's still coming up. It's still coming up.
it's now coming up. Okay. Okay. So yeah. So like I was saying, a few weeks ago, we had this introduction to the market of an approach, where we were looking at a brief intro into the concept of valuation, some of the approaches that is used in business valuation, and one of them was the market valuation approach, where you are looking at the value of a company in relation to other comparable companies, or you look at how comparable companies are being priced or are being traded, and then use that as a basis or benchmark for valuing another company. Okay. And then what we did also was that we did a bit of Excel of how to compute the multiples that will be used for the valuation. So today we are going to continue with from where we ended, um, and this is going to be a little more like Excel work as opposed to presentation. And again, I'm going to take my time a little bit more to kind of talk about the talk through the data basically, because the other time was against us, so we had to do a bit of a rush. So yes, so that's what today is going to look like. Yeah, so we're going to complete multiples and then use it for valuation. But again, we have to look at how we are going to control for differences as we discussed the other time. This is my screen sharing now.
So it's not up yet. Michael, can you confirm if his screen is up? Hello, Michael. Can anyone confirm if Daniel's screen is visible?
Good afternoon. No, it's not visible yet.
Okay, it's not visible yet. I can also see it's not visible.
Okay, please give me a moment.
Okay, no problem. Take your time. Sorry about that. I think Daniel will come back and join us very soon again. So let's still wait for our special guest. Is coming very soon. Okay, so welcome back. Yes, okay, your screen is visible now.
My screen is on now.
Yes, I can see it's very visible.
Okay, great. Okay. So yes. So here's where we are going to start from. So we started by developing the comparable the comps table at that time, and this is how the comps table looked like. So um, we're actually working on telecommunications, and we are trying to see whether MTN deserves the current price that it was trading at the time we had this session. So it was trading at approximately 12 cents. So what we did the other time was that we had to convert the financial numbers of each of the companies from their local currencies to USD. Um, so that we will have what uniformity, and we can easily compare the figures to see, for instance, its revenue within the same range. And so, and we are working on telecommunications, right? And from our session the other time, we discussed that when you are valuing companies and using comparable company analysis, you have to look for other companies that are similar to the company that you are trying to value. Preferably, it should be in the same geographical area, maybe the same country, if possible. Revenue, should be in a similar range. That means they should be of similar sizes, and so on. Right, the risks should be what similar, and so on. Right. So this is the list of the companies that we are using, including MTN Ghana itself, right? So that we see whether the current valuation of MTN, it's MTN really deserves this valuation of 12 cents. Okay, so this is the comps table. So we have the company name here, and then we have the share price, which is the current share price at the time, and then number of shares outstanding. So this one we used 2021 annual data, right? So 2021 year-end data for so the number of shares at the end of 2021, because that was the most recent, that was the most recent published financials, right? So we are doing the valuation based on that data, right? And then we picked total debts, which is made up of short-term and long-term debt for each of the companies, and then the cash and equivalent on the balance sheet of the companies, right? So we actually computed this from last session. Yes, but we'll just quickly brush through again. Yes, and then we have financial data here. So like I said last the other time, right? When you are doing comparable company analysis, the financial data, you can make use of how do you call it, forecasted figures. So what is the expected revenue of the companies next year, right? So you can use forecasted figures, which will give you forward multiples. And then you can also make use of the current financial data, because and we are saying that valuation is based on future cash flows or future earnings, right? So it makes more sense to use the forward or the forecasted financial data, right? So if you have financial data for 2022, that's forecast for 2022 year end, it would be better to use that that financial data. And you can get that forecast, as I said the other time, from maybe other websites like Capital IQ, and then I said Market Screener as well. But some of the companies listed here couldn't be found on Market Screener, and Capital IQ is paid for. So we decided to use current multiples because or current financial data, because at that time, the financial reports for 2021 had been released, and that seems to be the most updated financial data available. And then again, we also looked at last 12 months LTM. So I just wanted to also touch a bit on the LTM. So I've added it to the table here, right? So we have sales, now we have 2021, and then LTM. Now I've put E. The E actually means estimate, but then this is actually not the estimate, right? That's the actual for 2021. But I want to kind of, how do I call this? I want to kind of assume that as at the time we were doing the valuation, right, 2021 earnings report wasn't out. So that's the assumption I'm trying to make here. And I'll explain, why I'm making that assumption. Okay. And then, we are going to compute the multiples here. Okay. So let's see. Let's get started, and let's start with populating the table again. So we looked at market cap the other time, and we said that is basically the number of shares times the share price at that time, right? So this is the market cap of each companies, and then this is the total debt, and then this cash. So we need to find what we call net debt, which is basically you get your cash from your debt, right? So we do this, and then we find enterprise value. So enterprise value is simply the market cap, your market capitalization, plus your net debt. So enterprise value is the value of the firm to to shareholders and debt holders, but then excluding cash, right? Because cash is not really more like, it's not really like an operating asset, right? It's not really like an operating asset. So we net the cash from when we are finding the enterprise value. So here's the thing, and by operating assets, I mean like we are looking more at your inventories, your receivables, and then those kind of things, right? Now let's look at enterprise value. Now I want to add something here to enterprise value. Normally this would have been my enterprise value, but what if you have a company that has so you have a company, and most of the time when we are doing valuation, we look at financial statements. When you look at the financial statement, you see group and then you see company, right? Mostly we use the group financials, right? Now when you look at the group financials, you realize that maybe the group might have like a subsidiary, right? Maybe MTN Ghana. When you are looking at MTN group, MTN Ghana might be the parent company and have a subsidiary, right? Now that subsidiary, maybe MTN doesn't own 100% of that subsidiary, and so there will be some portion that belongs to other investors, and that we call non-controlling interest. Non-controlling interest. So when you are valuing MTN, right, you want to find the value of MTN to MTN shareholders. That's the shareholders of what? The parent company MTN Ghana. You would exclude what? The non-controlling interest. You would exclude the non-controlling interest. So that means that what? My market cap here doesn't capture my non-controlling interest. But if I'm looking at the value of the firm as a whole, the enterprise value, I would want to what? Add what? The non-controlling interest to my enterprise value here. The reason is that when I'm doing the reverse, in other words, when I find the firm value, looking at what? The free cash flows of MTN, and I find the firm value of MTN, I would have to come and deduct what? So we now want to come and arrive here, right? I would want to deduct my net debt from what? From my enterprise value. Then ideally that should have been giving me what? My market cap. But we are saying that what? Part of what? That free cash flows belongs to what? Non-controlling interest. So we would have deducted what? The non-controlling interest to arrive at market cap. And so therefore, if we are finding what? The enterprise value here, we'll do the reverse. We'll add what? Non-controlling interest. But here I overlooked that because of time. It's actually a bit tedious gathering data, and I actually had to pull this data from their financials manually. It is quite a lot of work. Sometimes some of the financial statements are even difficult to find. You go to the website and you don't find. You have to use other places. So so I overlooked a few things, and it's not just here. Some of the other figures I was supposed to get, but I actually have to put some dummy variables or dummy figures there, just to kind of save time for me, because I don't do this full time. So so I don't really have readily available data. So let me actually do this. So that's okay. So now now here is the financial data. So we're going to compute the multiples, right? We're going to compute the multiples that we use for the valuation. And the multiples, we did say that what if you have a multiple, let's say a P multiple of, let's say, 5, right? Then it means that what for every CD or every dollar in earnings of the company, the market is willing to pay what 5 what what 5 what how do you call it, $5, right? So for every CD of earnings per share of the company, the market is willing to pay what $5. Okay, so we'll be computing the multiples here, and then the multiples that we're going to compute. So we're going to use what the financial data and the market data. Now let me talk about the last 12 months here, because now we are here now, right? So the last 12 months, so like I said, assuming that as at the time we're doing the valuation, or let's assume that we are doing the valuation right now, and then 2021 annual report is out. But then let's say that what 2022 first quarter result is also out. Because we want to use the most updated figures for our valuation, we won't want to use 2021 annual report data. We want to include what the current earnings report that has been released, right? We want to make that earnings report for quarter 1 of 2022 reflect in what the valuation that we are doing, because the market responds to what the earnings reports that are being released. So we have to capture that in what our valuation. Okay, so that will mean that, assuming that we are doing the valuation right now, and then we have what quarter 1 of 2022 results out, we'll be doing what we call the last 12 months instead of using what the current annual report data. And let's look at what the last 12 months means. So let me come here and come to raw data. Okay. So this is what the last 12 months means. So this one, I'm actually assuming that what we've received quarter 3 of 2021 results. So which means that I'm assuming that we are doing this valuation maybe somewhere 2021, maybe quarter three ends when September, right? For a lot of companies. So if we are doing this valuation, let's say October, November, December, thereabout, when we don't have what the full annual report for 2021. Of course, that's not the case right now. Right now, what I should be looking at is to be looking at what if I want to do last 12 months, I should be looking at quarter one of 2022. But that data wasn't available for a lot of the companies here when I was gathering the data. So I had to assume that we are doing the evaluation somewhere after quarter three results of 2021 has been released. So how do you find last 12 months figures? So you have to look at one full year. So which means that what? So quarter three results, yeah. So the results that came before quarter three of 2021 results, we have to look at what full year report was released before what quarter three of 2021, and that's what 2020 full year results. Now we also take what that quarter three results of 2021 that we have, and again, since we are looking at quarter three of 2021, we have to go to 2020 and look at quarter three results from there as well. Now, here's what we are going to do. We are going to now take what? We are going to take what? The 2020 full year results, right? And then add on to it 2020 one quarter three result, because we want the current financials or current earnings to reflect in our valuation, right? But then 2020 seems to be old data, so we take it out, and then we'll get what this will be our last 12 months data. So that's what I've done here. So by taking the full year results before the latest quarterly results, right? And then we add, and then we subtract the quarterly results for the previous year. I know you get what I mean. So that's how we arrive at the last 12 months. So I did that for revenue, for EBITDA, and then also for earnings. So we have last 12 months revenue figures for the four telco companies, or 4 telcos, and then we have EBITDA for the last 12 months, as well as earnings for the last 12 months. Okay, so now let's go back to the listen. So that's where this LTM is coming from. Actually, by modeling principles, I shouldn't I shouldn't have this one as a blue font, because it's not an input. It's coming from somewhere. So let me use black or green, any of them. But it also depends on your convention that you want to use. So yeah, I think since I'm still using it as input, let me use green, because it's coming from another sheet. Is this green? Okay, let me get it some more. Okay, so let me zoom out a little bit. Okay, so yes, so now here's what I've said, right? That I'm assuming that the valuation is being done at a time where 2021 result hasn't been released, but 2020 the 2021 quarter three results has been released, and so 2020 full year result becomes like an estimate, because we don't have the actuals yet. So whatever equity research analysts have estimated that has estimated the things or things to be forward the year ended 2021 will be here as estimates, right? Now we're going to compute the multiples. So I have EV to sales. So I'm going to have my enterprise value. So this is my enterprise value. What I'm going to do is that I know that I'm going to use my EV to calculate EV over sales, EBITDA over sales, EV over EBITDA. So I'm going to have to lock this. I want it to come down when I'm coming down. I don't want it to move. So I'll lock it in this column J. So it stays there. So I'll put dollar before the J. And then what I'm going to do is I'm going to do divided by EV over sales. So EV over sales, this is sales. I'm going to do this and I'll do this, right? So let me bring it down. Let me drag it all the way actually to this. Yep. And then bring it down. Okay, so let me check whether everything is working properly. I think everything is working properly. Okay, everything is making profit. Okay, so now let's look at the PE ratio. So PE ratio is what? Price per share over what? Earnings per share. And like I said the other time, price per share, when we aggregate the total what? The total prices of all of the shares, we get what? The market cap, as well as when we also aggregate what, or when we total earnings per share, we will get what? Earnings. In other words, when you multiply, yeah, it's fine. So in other words, I can do market cap over here. So market cap divided by what? Divided by my what? Earnings, right? So my earnings. But I know that I'm going to use market cap twice. So for LTM and for 2021E. So what I'm going to do is I'm going to keep the column F in place. So put $ before F and then divide it by my earnings. So my earnings is here. So LTM. Then I'll drag here and I'll drag it down. Okay, so this is what I have for my multiples. Now we found the averages and then the medians of what? Of the multiples, right? We found the averages and then the medians of the multiples. And like I said the other time, because some of these multiples can be skewed to the right, yeah, we normally rely more on what? The median. So the median will give you what? A better this thing to use, because according to statistics, if your data is what? Skewed, don't believe your average, because your average will be what? Affected by outliers. So rely more on your median. So I have my median values, right? I have my median values. Now here is what okay, let me actually put this so that, because I realize some of the things are missing. Okay. So now some investors kind of look at what, want to see whether the stock is what, is cheap, right, or is expensive, right? Looking at the multiples. So is this stock really cheap or is it expensive? So looking at the multiples that I have here, let's see whether some of the stocks here are cheap and which ones are what, expensive. The easiest way to do that is to what, compare the multiples that you have to what, the median, right? So compare the multiples that you have to the median. So let's see something. So all the multiples, right, or companies that are trading at multiples, companies that are trading at multiples below what, the median, can be seen as what, underpriced, right? They are underpriced or they are cheap, right? And then companies that are what, trading at multiples above what, the median, can be seen as what, as overpriced or what, or expensive. But today we are going to see that it's how do you call it? It's not enough for us to just do this comparison to the median and just say that, oh, this stock is really cheap, right? Because some stocks are cheap because they deserve to be cheap. And I'm quoting Aswat Damodaran, because he says that some stocks are cheap because they deserve to be cheap. Right? And I'm going to do what we call controlling of differences, and something that he stresses on, Aswat Damodaran stresses on a lot when he's talking about relative valuation. So let's see whether the stocks here, which ones are cheap based on the multiples that they are trading at. So when we look at it, we see this one, right? I mean, we can decide to use some form of conditional formatting, right? But I think we don't have that much time. So I'm just going to handpick some of them, and then we'll say that, okay, maybe this company is cheap because of what, this and this. So let's see which companies are, Yes, can you hear me? Is there
Okay,
anything?
Daniel. Yeah, so I think Akim has a question. So I think he should
Okay.
read it out for you. So Akim, can you unmute yourself and read it? Akim.
Yeah, sir. All right.
Hello,
Thank you.
Akim.
Yes, I'm with
Okay.
you. Can you hear me?
So
Yes,
Yes.
please. You can hear
I
you.
can hear you. Can
When
you
you
loud and clear?
divide the EV over 6, you are getting 3.7 x, which is 3.7 times. But now, if you normally when you divide, you will get something like this. How do you manage to do it? That you have a 3.7 times comma.
Okay, the X at the end.
Yeah.
What?
Sorry.
Yeah, I say it
Sorry, come
meant the
again.
X at the end. It meant the X at the end.
I can hardly hear him.
So it's actually how you I got the X at the end.
Oh, okay, okay. The X is just formatting.
The
So,
format.
yes, I just want to make sure that because this is a multiple, I want to show it as what a multiple. A multiple is something X or something something times. Now, this is how I will do my multiples. So, I can come here. So my number, or my formatting, whatever. I actually don't know the names of these ones. But yeah, I can come here and then I'll go to what more number formats. And then what I want to do is that I want to give it a custom format. Um, and so I'll come here, I'll choose any of these, but I want it something point something, then it should bring the times. So I'm going to choose this one so that it will be 0.0, but I want it to end here. I want it to be something point something and then include X. So I'll just do this and then add the X to it. And then when I do OK, it will just change it to multiple for me. So that's just it's just a formatting. Yeah. Okay.
Thank you.
So okay.
All right, thank you.
So
Thank you.
okay. Please, is anyone asking a question, or I can go ahead because it's breaking at my end.
You can go ahead. You can go ahead. We're all good.
Okay.
Thank you.
Okay. Okay. Sure. Okay. So let's see where. Let me actually give this a white this thing so that the contrasting is okay. Good. Good. All right. So let's see which stocks are cheap and which stocks are expensive. So the median is 2.5 when I'm looking at what EV to sales. So it's 2.5 for last 12 months, and then 2021 is 2.4. Okay, so let me look at excuse me. Let me assume I'm using the last 12 months. So the stocks that are be above what 2.5 is this one. So this first one, and then this one, right? So these are the two stocks that are what above the median. So these stocks can be seen as what expensive, right, or over priced. But is it really overpriced? Maybe it's overpriced beyond its peers because it deserves it, right? And we are going to look at that, right? Now let's see, and then it means our these other two, Telecom Egypt and MTN Ghana are underpriced, right? Are underpriced. So let me highlight it in red. Um, or maybe they actually deserve to be cheap, but we'll see that when we get there. So these are my multiples, and then this is how at a glance I'll be looking at what which companies are can be seen as cheap and which ones can be seen as expensive. I can also look at the PE, I can also look at the EBITDA and then use it to draw that conclusion. But now let's see. So what we said the other time is that now having done this, ideally we'll just pick the median for what for the multiples, right? For the multiples of the peer companies, right? And then use it to what to value what MTN Ghana, right? And we looked at the fact that we'll bring down all the multiples here before we actually go ahead and value it. But this is what I want to do here. I want us to clean up the multiples and then get the adjusted multiples before we come and then what value MTN, so that we see what is the true value of MTN after we've controlled for what differences. After we've controlled for differences. So let's see what are let's see what we call the drivers of multiples. In other words, what makes this company have what an EV to sales multiple of 3.9, whereas this one has an EV to sales multiple of 1.4, and then what makes what MTN Ghana has a PE multiple of 4.4 times, and then what and then so let's see. Okay, so the drivers of the multiples. So according to this, uh, of what multiples are, right, of valuation multiples are. So if you want to learn more about how he arrived at what the drivers of each multiple is, you can check on YouTube. He has a series of videos on on relative valuation. So I think he calls it pricing. So, and it's closure on pricing. So after he had taught relative valuation and he was trying to close off, then he looked at what the drivers are. So you can check him out on YouTube. And again, yes, all these lessons on controlling for differences is coming from him. Yeah. Okay, so let's see how we then control for differences. So according to Aswat Damodaran, the PE multiple or the PE ratio of a company, the drivers of the multiple are the growth or expected growth in earnings, the first one, and the second one is what is the risk, or which is measured by what the cost of capital of the company, and then also return on equity. So these are the three drivers of what of PE multiple or PE ratio. So if a company has what a high expected earnings, low cost of equity, and high return on equity, then you can expect the company to have what a high PE multiple. And then the drivers for EBITDA. So this one here is equity valuation multiples. That's the PE. We have price to book as well. I think price to book. Let me bring price to book here. But as you have noticed, we are not using price to book in this our analysis, because like I said earlier on, price to book is mostly used for what for leverage businesses or financial institutions like insurance companies and banks, right? Because for them it's difficult to have what the equity value going to zero because of the tight regulation that they face. Oh, actually we've spent half of the time already, so let me speed up a bit. Okay, so price to book, these are the drivers: return on equity, expected growth rates in earnings, cost of equity, and then what dividend payout ratio. And then when we come to EV over EBITDA, these are what the drivers. So what is your cost of capital? What is your expected growth rate in EBITDA? What is your tax rate? And what is what your return on capital? The return on capital, which is which you can also use reinvestment rate in place of. And then we have EV to sales. So EV to sales, you have operating margin, you have cost of capital, and we have what reinvestment rate. You have reinvestment rate. So here's what I'm going to do. Now let me come here to PE. So let me clean up the PE, and then we can have the adjusted PE that we use to value MTN Ghana. So let me actually. Okay. So I have what my PE multiples. I have earnings growth, expected earnings in what MTN's what expected growth in what the company's earnings, the cost of equity. So cost of equity, I did a bit of calculation here. So I mean, yes, you can do that. And then return on equity. So here is where I got stuck. Oh, I think I actually have return on equity data somewhere. So let me go to data. Return on equity should be here. Yeah, return on equity is here for each of the companies. And then earnings growth. So let me also take that from my raw data. So earnings growth. So earnings growth is here. Okay. Oops. Okay. Let me go back. Earnings growth. So earnings growth. Okay. So these are what is determining or what is driving what these PE multiples here, right? This is what is driving these PE multiples here. Again, I can do the average and the median, right? So that I can, use that to make some form of analysis. So let me do this and then also do median here. Okay. So these are supposed to be percentages. So let me just do this and then do this. Okay. All right. So now let's adjust the PE multiple. Let's clean it up for MT. So here's what we are going to do. We are going to run a regression, right? We are going to run a regression. In other words, we are going to regress these factors, right? I don't know whether this is going to be regressed on this or this is going to be regressed on this, whichever. But I'm going to do a regression, and this is going to be my what? Independent variable. Sorry, my dependent variable, and this is going to be what? My independent variable. So let's see how I'm going to do this regression. So I'll go to data tab and then go to data analysis, and then look for regression here. I'll open it up, and then input y range. Y is my what? Independent variable. Is it independent? No, actually my dependent variable. So those are going to be my multiples, right? So I'm going to select everything from the top. And then my input x, I'm also going to select everything. Sorry, I shouldn't include the median and average. So I'm going to select everything. And I'll say, yes, my data has labels. Okay, let me make the results show in this Excel sheet because I don't want to have a plenty sheet. So output range, let me click here and then just say that my results should show somewhere here. And now just click OK. Okay, so now I have a regression, right? I have a regression. And one thing I noticed is that what? I need to check my R square. My R square is 1. Interesting. Okay. So R square ranges from, I think, 0 to 1, right? My statistics people, if you have statisticians here. Or does it show as a percentage here, like 65 and things like that? Anyways, so what I'm seeing here is that actually there's a problem with what I have. So what I'm seeing here is that my p-values are not showing. Maybe because my data is too small. But let me do this again. Okay, so let me do regression again. Okay, so regression. Okay, so this is input y, it's here, okay. And then input x is also here. And then I said that, yes, my data has labels. Then I should show this here. Oh, sorry. This is supposed to be my input. This output range should be okay. Oh, I'm still having my p values to be listed. What could be the issue here? Okay, I think sometimes the data size actually sometimes when it comes to statistics needs to be quite big. But let me see what I can do to. Okay, let me actually try this. Okay, so unfortunately, I have my p-value as an error. Um, I'm not a statistics guy, so I don't really know what is wrong. But here's what I'm doing this, here's what I'm doing this kind of regression to do. So I'm doing this regression to see, okay, what are the things driving what this PE over here? And the drivers of the PE says, first of all, there's an intercept of what 105.74. Okay, so we start off from there, and then what also negative what 164.51, the first variable, which is growth, right? And then negative 116.18, which is the second variable, and then this one. This is a bit weird. I'm coming. Let me just apologies. Let me just change some of these figures. Let's see Let's just work with some random numbers. Let's say 15, let's say 18, let's say 25. Let's say, okay, 10 equity, let's see. Actually, I think my data gathering was a bit shabby, especially when I got to this part, my return on equity and cost of equity. I was Googling some of the numbers instead of going to a proper way of maybe looking to the financials and stuff like that. So let me try again and see. Okay, so regression. Let's see what we get this time. It's still giving me none. I don't know why it's giving me this, but let's just continue the way it is. Let's just continue. So here's what we are going to. Here's what my regression would mean. That my multiples start with what 10.56, and then for what every percentage growth in what in my earnings, right? Every percentage growth in my what earnings per share, right, or net income, PE ratio will what increase by what 76.5, right? And then for every increase in cost of equity, my PE will what reduce by 80.7, and that kind of makes sense, right? Because cost of equity represents risk. So the higher your cost of equity, the riskier your company. So it means that your company actually the value will fall a bit when the cost of equity rises. And then return on equity, for every increase in return on equity, I have what multiples, my multiple going up by what 2.899. Now I need to see which of these ones are statistically significant and which ones are not. And so I needed to be comparing it or be looking at what my p-values. So if I have a p-value of less than what? So p-value less than what? 5%. So that's 0.05. Then I will say that what this variable is statistically significant. Let's assume that what all these ones are statistically significant, because sometimes when you do it, you realize that some of them might not be statistically significant based on the data, right? So let's just assume now that everything is fine. So it means that what here is what we are going to have for the adjusted PE for MTN. So we're going to pick the intercept, right, and then plus what the earnings growth. So earnings growth, this is what the coefficient of my earnings growth. So it means I'm going to multiply it by my earnings growth for MTN Ghana, because that's what I'm looking at, right? MTN Ghana, and then plus what the cost of equity times, or actually Excel doesn't understand brackets. So let me put multiplication sign there. Let me put multiplication sign there. So it means that I can decide to put the bracket, these two instead in brackets, right? So that it multiplies them. And then I also do this times what this is cost of equity. So the cost of equity for MTN Ghana, I'll put those two again in brackets, and then plus this ROE times what the return on equity for MTN. Okay, so this will give us the adjusted PE for MTN. Let me copy the formatting here and just have it this. So it means that what the adjusted PE for MTN is what 4.93. Let's compare it to what we have. It's giving us the same thing as this, because we are assuming that everything here is statistically significant. But there are some cases that when you do some of these things, some of the variables will have to be thrown away because they are not statistically significant. So if we do it and we get this, it means that what even though we get how do you call it? Let me come here. Let me go here. Oh wait, where was I? I was here, right? I was here. So even though we are looking at MTN Ghana, the PE multiple, right? Looking at the PE, we are saying that what MTN Ghana is what is underpriced, right? Or is cheap because it's what is lower than what the median, right? Because the PE multiple is lower than the median. The regression result is telling us that, wait, look, actually, this should be the true multiple of MTN based on what? Its growth, its expected growth in earnings, based on its cost of equity, which captures risk, and based on what its return on equity, which captures profitability, MTN actually deserves to be cheap. MTN actually deserves to be cheap, because look at it. You realize that what cost of equity, MTN is more riskier. MTN Ghana, when you look at cost of equity here and you compare it to the others, it's more riskier than the others. And the riskier your company, the lower the value of your company, right? So, and then when you look at the return on equity, it's actually not the highest. It's what below this one and this one. So, because MTN has what a higher cost of equity and a slightly lower or relatively lower what return on equity, as well as what even the growth. The growth is not the highest. It's like the third in the range, right? Third out of what the four, right? So because of these characteristics of MTN actually deserves what the value that it is getting. So it deserves to be what to be cheap, right? But assuming we had done this and we realized that what the adjusted PE, for instance, gives us something like 5 times, then it tells us that what based on the characteristics of MTN should be trading at what a PE multiple of 5 times and not 4.39. So it tells us that what even though the market is saying that what MTN is cheap, MTN actually doesn't deserve to be what to be cheap. In other words, MTN deserves what to be trading at a higher price than it is trading currently. And so this kind of gives us what tells us that what MTN deserves a better pricing. And so this will help us to understand that truly MTN is what is cheap, and we need to what for instance, if you want to buy this stock, you should buy it because what it is what trading at what a multiple that is what lower than what it actually deserves, right? So yes, once we do our multiples, we have to do a multiple linear regression based on the factors that what drive that multiple, and then we do an adjusted what multiple for the company, and we can determine whether the company is really cheap or what, like whether the company actually deserves to be cheap or it doesn't deserve to be cheap. So let's see. Let's assume that so we might like, or would have to what do the same thing for what EV to sales as well. Let me quickly see what we can get for that. So the list of companies is here. Okay, so the list of companies is here, and then let's have what the drivers of the multiple. So the drivers of my what this is EV over sales, right? So the drivers of EV over sales are these, right? So these are my drivers. So let me copy them. Let me transpose them. Okay, so these are what my drivers, right? Now assuming, so again, like I was saying, because of time, the data gathering process is actually a bit tedious, so I couldn't finish gathering these things. Now operating margin, as we all know, is what my operating income or my EBIT over what over my sales, right? And then we have cost of capital, which is your work, right? And the reinvestment rate, which I said is what your return on capital, your return. So your return on capital is, I think, is NOPAT over what over capital employed, right? And NOPAT actually is net operating income after tax. So you look at your operating profit and you adjust for tax. So operating profit into bracket 1 minus tax to give you what your NOPAT, and then you divide it by what, your invested capital. And invested capital sometimes can be defined as what your total equity and what your long-term debt, right? Other people might want to define it differently, especially because of ratios. When it comes to ratios, I mean, you can have different variations in the definitions of the ratios. So let's just assume something that okay, so let's just assume an 8% here, a 9% here, some 12, then some 15, and then let's say cost of equity So cost of capital. Let me just assume that my cost of capital is the same as cost of equity here, which means I'm kind of assuming that these companies do not have debt, which is not the case, really not the case. Now, return on invested capital. Let me see whether Excel can give me some estimates. Okay, let's just assume that we are working with this. Let's just assume that. Okay, so what I'm going to do now is I need to have my sales multiple for sales multiples. I need to have my sales multiples for each of the company. So I'm going to go here and then sales multiples. So let's assume I'm using the last 12 months. I think that's what we used. Because of time, let's just use that. So last 12 months. Okay, so let me okay, so for MTN Ghana, the adjusted EV to sales. Now let's do a regression and then see what we get. So I'm going to select all my data here. I'm going to go to data tab, and then I'm going to go to data analysis and then regression. Okay, so this is what I'm going to do. My input Y has been selected, and then this one has also been selected. Okay, so I say my data has labels. I think that's okay. Yeah. So interesting. So thankfully, we have this one giving us the p-values for some of them and not some. So let's just assume that those ones that we don't have the p-values, they are not statistically significant, because we can't make any decision based on them, right? So we are going to knock them off. Now this one has a p-value of what? 0.01, and then we are comparing it to 0.05, right? So if the p-value is less than 0.05, then it means that that variable is statistically significant. So it tells us that this intercept here is statistically significant, and then the reinvestment rate is also statistically significant, because the p-value is less than 0.05. Okay, so this is how we are going to do the adjusted multiple for this one. So we are saying that the multiple, what drives the multiple is, first of all, the intercept, right, plus these two, operating margin and cost of capital, are not statistically significant for this data. It doesn't mean that they actually don't drive these multiples, but sometimes based on the data, we are saying that it's likely that the market is pricing this company based more on its reinvestment rate. That's what this would imply, rather than its operating margin and cost of capital when we look at the EV to sales, right? So I'm going to have this. Let me multiply this by So this year by the reinvestment rate for MTN Ghana. So reinvestment rate of 12%. So this is the multiple that it gives me. So how will I interpret this? Well, I know that this is the EV to sales that I'm getting for MTN, right? 1.4 from what I calculated earlier. But when I adjust for it, I realize that though we are saying that MTN is cheap, right? It's cheap because when you compare it to the median, which is, where is MTN Ghana? So MTN Ghana is 1.4. When you compare it to the median of 0.5, it's cheap, right? But does it deserve to be cheap? No, it doesn't deserve to be cheap, because the adjusted multiple tells us that MTN Ghana should be trading at at 8.4 times its sales value. It should be trading at 8.4 times its revenue. So it means that if you want to buy this stock, this is a great stock, because the market is pricing it lower than what it actually deserves, right? But because of the limitation we have here, we don't have the p-values for these two. We can't actually rely on these results, right? So most of the time, statistics, the more your data, the more reasonable results you will get, right? And again, whilst you're also doing it, you also look at your R squared, right? Because very high R squared means that the multiples are being explained, like by what? These other factors, or the variation in the multiples is what? How do you call it? It's being explained, or the variables here, right, explains 99.9% of the variation in the multiple. So the R square is also very important when you are doing regression, right? So yes, the more your data, the more reasonable results you come up with. But again, I don't do equity research full time, and so I actually don't have like data that I'm going to use, nor do I have access to the tools that will make it easier for me to gather data on companies, right? So I had to actually do this manually. So at a point, I had to just put random numbers there. So let's now see. I know we are out of, it's 2 p.m., but sorry, 1 hour since we started.
It's
Yes, I'm in a different thing. But let me just quickly wrap up if I'm permitted. So just
Go on, go on, go on.
okay, I can wrap up, right? Okay, so now let's bring down the multiples that so then be using the adjusted multiples to do the valuation here, right? So my adjusted multiples, so EV to sales, we are saying that what MTN should have this. So this is the adjusted multiple that we are going to use to value MTN. And then EBITDA, we didn't do it, right? But then let's just assume that for EBITDA is the same thing as what as how do you call it? Is the same thing as what the median, right? Let's assume that yes, there's no issue there. So let me use the last 12 months since that's what we've been using. Okay, and then EBIT. So I had to remove EBIT. So yeah, from the last time, and also remove one company because it was difficult getting data for that company. Yeah. So let me now choose my PE. So my PE is here. I'm assuming that this is the adjusted. Okay, so now let me copy this format. Yeah. Okay, so EV over sales. So my enterprise value, right? My enterprise value. Oh, actually, I have my data here, right? And what do I see? Enterprise value will be what? Um, yeah. Okay, so I have my multiples, right? And I'm going to find. Okay, so here's what I'm going to do. So using EV over sales, my enterprise value is, so the ratio is enterprise value over sales, right? So if I want my enterprise value, I'll have to multiply what the multiple by what my revenue or my sales, and then do the same thing. When it comes to EBITDA, I'll use the multiple to multiply my EBITDA, and then when it comes to PE, again I'll use PE to multiply what my earnings. No, sorry. So this is what I will have, right? Well, we know that PE is what? Earnings and then what? And then the price, right? So it means that what? I can get the price directly by multiplying what? The PE by what? My earnings, right? So actually this is supposed to be market cap. Sorry, my bad. It's supposed to be market cap. And so enterprise value here is going to be this plus what? So as we looked at earlier, from when you're moving from market cap to enterprise value, you have to add your net debt to it. So my net debt is here. I'm going to add it. Okay, and then again, market enterprise value. When I'm going to get before I get my market cap, I have to subtract what my net debt from my enterprise value, right? Because the value of the firm to equity holders is what the value of the entire firm, excluding what what belongs to debt holders. And again, like I said, when we have what non-controlling interest, we would have deducted the non-controlling interest here because we are looking at the value of the firm now here to what the shareholders of what the parent company, right? So again, I'm going to do this, and then what subtract what my net debt from it. Okay. So my share price is going to be my market cap divided by what my number of shares outstanding. So it's the same thing. So I'm just going to lock it in place and then drag it down. So it tells me that what this is how much MTN Ghana should be trading, given what my analysis. This is the share price. But remember from the other time, we are working in USD or dollars. And so if you want the share price in cedis, you would have to convert this, right, to Ghana cedis. So I was using the exchange rate that was prevailing at that date to do the conversion of the share price, because the share price was as at that date, right? So the exchange rate is kind of also on that same day. So let me take these share prices and then multiply it by my exchange rate for MTN Ghana, which is what the dollar to CD rate. Sorry, the dollar to CD rate. Let me log this in place so that the same current the same what currency will be used. Oops, I actually logged the wrong. Oh, okay. So this times what the share price? Yes. So I mean, it kind of tells you that what this is how much MTN Ghana should be trading. When you look at it from what enterprise value to sales perspective, this is how much we should be getting, and then EV to EBITDA, this is how much we should be getting, and then what PE, this is how much we should be getting. But again, you know that what this thing here is what is not really correct, right? Because as we saw from here, we had to rely only on the reinvested capital. When in actual fact, these ones can also play a role, but because of what the p-value issues with what p-value, we had to drop that, right? Yes, and then for the PE, it tells us that what all that things being equal, MTN should be trading, MTN Ghana should be trading at 90%. And let's see what the current price of MTN Ghana was at the time. So this is the price, right? This is the price. Let me just convert this quickly. Let's see what we get. Yeah, it's kind of yes. So this is it, right? It's what it was trading at 90 pesos at the time, right? So it tells us that what, yeah, all that things being equal. My time is up, right?
Yeah, we're having another section less than an hour now.
Oh,
So,
okay,
but
okay. So
yeah.
so let me then wrap up. Then okay. So let me just close. So yeah. So this is I mean how we will do what relative valuation, and then we control for differences to make sure that we are using the right multiples to do the valuation of the company. Yeah. Thank you.
Awesome, 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 awesome. Daniel, thank you very, very much. I've also dropped the link for some of you that might be interested in connecting with Daniel on LinkedIn. So I've dropped the link on the chat box. So I'll share it again. Daniel Mensah is from Ghana. So I'll share it again. Daniel, you've been to our section before, so you know the question you usually ask. You should ask, okay, just like briefly, how you started your own financial modeling journey and what advice you have for people just starting out in the field of financial modeling.
Okay. Okay. Thank you, Temi.
Yeah.
Yes. So it's Temi Dayo. That's the full name,
No problem.
right? Okay. Okay, so yes, my journey in financial modeling, started from school. So you were introduced to financial modeling. It was actually more like extracurricular, where we were doing it like a competition, but there was training before the actual competition. So I participated in the training, and I actually enjoyed, the whole. So it was introduction into Excel, and then using Excel to solve some business problems, and then we delved a bit into, financial modeling, where you are now forecasting financial statements, and then you are doing valuation using, I think, the free cash flow. You're using the free cash flow approach. So that's where everything started from, and after that program, I kind of realized that I enjoyed it, so I decided to take it further, and then I enrolled in CFI's FMVA program, and then I learned more about modeling best practices, and then business valuation using the BCF approach, using the market, the relative valuation. Um, Yeah, so that's how my financial modeling journey started. And you know, even though like I felt like the training was great, I felt like it wasn't enough because I mean after the training,
Yeah.
I, I had a chance to kind of work with the venture incubation at Ashesi, where I was building
Oh.
financial models for startups, and then also alongside I was doing you know more like pro bono for a couple of people, not a lot of
Yes.
people, but just a few people. Like, so I have a friend maybe wants to start a business or wants to go into venture into business, right? And then or raise funding. Yes. So my recent work I did was for an AI startup to raise funding. So these are some of the things that I've been doing, and I realized that that knowledge alone from CFI wasn't enough, although it was a great start off because these are startups, and working on startups or building financial models for startups is quite different from a matured company because I mean this startup maybe they don't have any historical financials, and you have to get all the data from scratch and then build the model. So I had to attend sessions like this. So I've been here before. I've come on the BBZ financial modeling
Yeah.
program before. I've also watched. So there's this video I watched on financial modeling that Michael Lafusi posted. It was a 3 hour video that he posted on YouTube that I watched some time ago. It was really eye opening because at the time I had done CFI, but my understanding of the cash flow statement wasn't really deep. And by doing that, I realized that actually there were a few more areas that I need to pay attention to when it comes to the cash flow. And again, I've also been with Deep Brown Consulting, joining their financial modeling webinars, and also joining Victor when he's organizing his style boot. Yeah, and I've actually learned a lot through all these
Oh.
places. Yes, to kind of help me, with my modeling. And today, when I look at my first model that I built, I bow my head down in shame. And I'm like, so a financial modeler did this work. So yes, that's how the journey has been.
Yeah.
Always consistent learning. Yeah, whenever I get the opportunity.
Awesome. Awesome. Nice. That was lovely. So your advice is we should keep learning every day. So life is like
Exactly.
it's more like a continuous learning. Okay, so someone in the audience asked that can we get a template for practice?
Okay. Yes. It's not well organized though, but let me see. Can I
Okay,
put
what
it?
you
Okay.
no,
Yeah.
what you can do, you can send it to Benny like via email or LinkedIn. So I'll just upload it when I'm uploading the video on YouTube.
Okay. Okay. That's fine.
Okay. Awesome,
But
awesome, awesome.
okay. But if they also want me to upload this one right now, also,
Okay.
I think that's fine. Yeah. So
Okay, no problem.
okay, let me upload this one, and then maybe if I get the time, um, I'll try and
Yeah.
then organize it properly.
Okay, yeah, thank you very much. As you're doing that, let me just be telling them. So we're having another section by 4 p.m. UTC.
Sorry,
So we're
I,
having Google Sheets.
the line is really breaking.
Okay. So just continue what you're doing. Continue what you're doing.
Okay, okay.
Just continue. I'm just telling them we're having another section by 4 p.m.
Oh,
titled Google Sheets. So I've dropped the
okay,
link. I'll drop the link again for some of you that might be interested. Is our Excel section.
okay.
Okay, so Mensah, when you send the link, we can close the section for today.
Oh, I actually need to send a link. I don't have it online. Okay, so
Oh,
then let me do it when yes, let me do it later and then send the link to you so that
okay,
it's not.
okay. Also, so thank you everyone. Thank you again, Daniel Mensah, for honoring our invitation. We hope to invite you again on another future section. So everyone, bye guys. So Mike, you can stop the recording now. Bye everyone.
Okay, bye. Thank you.
Bye. Thank you very much.